This is Bazaar Morning Call, broadcasting live from the CNBC TV18 Motilal Oswal studios in Mumbai.
Good morning, you're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC TV18 Motilal Oswal studios. Thursday morning, start of the beginning of the end of the week, if I can put it that way. I'm Prashant.
Love the perspective, Prashant.
You can put a positive spin to anything, Surabhi.
Absolutely.
Morning, guys.
Good morning. I think Nigel and I kind of in shades of white, pristine, waiting for things to kind of ease out, because yesterday we had a lot of choppiness, a lot of volatility in a narrow band. So let's see how today goes.
Actually, I was noticing the intraday yesterday. It was flat and dead through most of the session, at least on the Nifty, right? And at 240, 250, there was a rocket.
Yeah.
And the rocket, of course, was thanks to the big move that we saw in Reliance Industries. I mean, I think almost single-handedly, with a little bit of help at the margin from ICICI Bank and HDFC Bank, but it was Reliance all the way. I mean, I think about 60, 65 index point gain on the Nifty came through from just one stock, a 3% move on Reliance, and it all happened post 240. Till then, absolutely flatlined the way we started is how the session was going. Now, overnight, Qs are not bad. So there's not very much to take through on the dollar or the yields, etc. So not very little by way of change. But you got equities which were higher, especially the Nasdaq. You should take note, 0.75% up once again. So with what we've seen this week so far, I think US is now flatlined for the year. It was down 1.5% last week. This week it's basically gained by almost that much. You had some comments coming through, which markets so far have completely ignored. But, with some of these things, sometimes the reaction is a day late. So you had Fed's William, who basically sounded hawkish on the balance sheet. As I said, market was not convinced. I'd just like to read out the quote in terms of what he said. He said the FOMC said that it intends to slow and then stop the decline in the size of the balance sheet, which is basically QT, quantitative tightening, when reserve balances are somewhat above the level it judges to be consistent with ample reserves. And then the punch. He says, so far, we don't seem to be close to that point. And this is essentially what was... Of course, this is hawkish as far as the transition from QT going slow, then stopping, and then eventually at some point QE starting again. And like what we've seen, expectations of the first rate cut being pushed back. I mean, I guess this is Fed's attempt out there, putting its people out there, saying, well, don't get too eager and sort of don't make it too imminent in terms of expectations. This will be a long, drawn-out kind of process. Markets, for now, ignored it. Now, later tonight, in terms of just data and what things to watch, we'll watch, you get the US CPI numbers, which I think, as we've been saying, is the single most important data point this week. There are some of the margins say, well, it doesn't matter now, inflation numbers, because, the trajectory is set. If not nothing, you basically will have the base effect ensuring that inflation numbers, at the end of the day, inflation is the rate of change. That's starting to drop. But I think for now, this is still, I think, will be keenly watched. More on that later. Oil prices, which have been volatile actually last 3 or 4 days, they were down about 1% at just under $77 a barrel. Now let's just circle back to the levels here. Yesterday we were asking the question whether the market is going sideways or maybe even entering a bit of a corrective phase. Well, you always get something. Like yesterday, something was Reliance and that big move that we saw. So the Nifty, as of yesterday, took support of the 20-day moving average and then actually bounced. We need to see... And before I get to supports, etc., we need to see if we are able to get back to that 21,763 levels, which is the high that we saw. If that is not broken on the upside, then, I mean, those doubts will linger, whether this is a slightly more sideways downward kind of phase. So I think on the upside, the marker which will tell you that, I think it should be about 21,763. Now, supports for the Nifty will come in at two levels. One is the 20-day, which stands at 21,488, and then the low that we saw yesterday, which was below the 20-day, but which was 21,447. So pretty close by, 21,488 and then 21,447. Break of these supports, I mean, only if you get a break, a decisive close below it will take you down to about 2970, which is nothing but the 40-day exponential moving averages. I still think we are in a bit of a flux kind of a zone, a ranged kind of trading action without too much by way of definitive price action. Nifty Bank seems to be in a bit of a sideways phase as well. So we need to see, again, the negation. If the high of 48,382 is not broken on the upside, that is 48,382, which is what the market needs to stay under if the market is to make the bears, stand a chance even. So that's the number on the upside. And on the downside, you basically will see the 40-day exponential moving average. I mean, if the break comes through, which is basically 46,720, that is, not very far away, but it's not very close either. So we'll see how things go. As I said, still a bit of a ranged kind of price action is what we should find ourselves in once again. The GIFT Nifty is indicating a 25-odd point higher start. Surabhi.
Oh, no, absolutely, Prashant. As commentators for us and market participants, we would want to see decisive moves on either side, right? But markets don't have to oblige. Markets can be in a range for long periods of time. And after the rally that we've had at the end of the year, perhaps I'm in this January range. Who's to say? We could perhaps be in it for now. The one market that's in no range at all, by the way, is Japan. I just wanted to put that out. The Nikkei has hit a very historic level of 35,000 plus this morning. It's unending, the rally in that market. It was the best performing market of 2023. And while we are dithering and we've gotten into a range here in India, Japan knows no stopping, and that's up another 2%. Last time that index was at these levels, it was early 90s. Pretty historic moves in Japan. Anyway, coming back to the point over here, as Prashant mentioned, you had an uptick on all the key indices. Between 0.5%, about 0.7%, or 0.75%, depending on which one you're looking at. Just to put the number in context, if you're going to watch for that CPI print, the expectation is in December, CPI is going to be at this level of 3.2% year-on-year rise and 0.2% month-on-month rise. And if we get a print of 3.2%, it'll be very similar to the rate that we saw in November. October, the pace of increase was 3.2%. November, it fell to 3.1%. And again, the expectation for December is that we'll be around that vicinity of 3.2% yearly rise in U.S. consumer inflation. The more exciting news really overnight was what everyone's talking about, and that is the approval to this Bitcoin ETF by the SEC. I must admit, I don't track the crypto market very closely, but this made me do that for just a bit. So what happens is that this, of course, stems from the fact that the US SEC lost that case to Grayscale back in August. And that's when the expectation rose that they will have to come out and approve the ETF. They've done that. Now, Grayscale Trust has Bitcoin holdings of about $29 billion. And this gets converted to an ETF. The expectation is that there will be others because the likes of BlackRock have already filed for products. But I want to just read out the statement from the US SEC. How should we read this when you've got to go between the lines? Is this an all clear for cryptos, blanket all clear? Perhaps, we have to take that with a pinch of salt. And I go to the statement. Today's commission action is confined to ETPs holding one non-security commodity, Bitcoin. It should in no way signal the commission's willingness to approve listing standards for crypto asset securities. Nor does the approval signal anything about the Commission's views as to the status of other crypto assets under federal securities laws or about the current state of non-compliance of certain crypto asset market participants with federal securities laws. It's still sounding a little hawkish. They're watching the space carefully, but you have the approval, and that got a lot of the other cryptos like Ether, etc., excited, 15% higher, Litecoin, and all of these other coins that were up and about, still are, by the way, this morning. So the crypto market's quite exciting. Back here for us, again, watching for the lows because we've been protecting the lows. No matter the volatility, the Jan range is intact on the downside. And we had that test of the 20 DMA on the Nifty, 21,450 thereabouts. So let's see if that continues. Yesterday, that last hour surge, if you thought it was FII money, well, actually, no, it was domestic money. And that's the picture, 2,000 crores on DIIs. FIIs were actually on the sell side yesterday. So that's also interesting. We'll watch for that. Of course, today it's going to be all about TCS and Infosys. Numbers come in after market hours, and the expectation is very feeble, flat trend on the top line to negative trend. And I thought I'll put the revenue estimates that we have here at CNBC TV18 up for you. Down 1.8% for Infosys, flat for TCS. This is, of course, the best case scenario. The market really wants to hear the management speak. And if there's any indication that this is the bottom and they're seeing improvement in US demand, we know what that will do to the IT pack. But for that, we have to wait for post-market hours, I guess. So we have to just watch for the range, I think, as we start off, Nigel.
Well, yesterday, typical textbook stuff played out. The Nifty went to around the 20 DMA. Normally, when you hit the 20 DMA, either on the upside or the downside, it normally rebounds, in the opposite direction. And that's precisely what happened yesterday. So the Nifty defended the 20 DMA. Today, we have the weekly expiry that plays out as well. So that adds a bit of a volatility. Yesterday, we had the Nifty Bank that played out weekly expiry. And after a while, at least it didn't underperform by a big margin. Yes, it was up only around 0.3%, while the Nifty was up 0.4%. But it will see resistance at around the 20 DMA odd. Infosys and TCS, both of them come out with a set of numbers post-market hours. So tomorrow we'll have the tech pack that will be reacting to those set of numbers. What did the FIs did? Well, they added some mild short positions and they unwound some long positions. But they're in that vicinity. 60 to 70% is the long position that we've seen. I would actually like to see the short positioning go up, because if you can get a positive surprise coming in from one of these heavyweights, then that's what gives us a reason to move up. But for the time being, the shorts are holding around 37%. In an uptrending market, you want to see the nearest put see some writing, and that's precisely what happened. So the 21,500 put yesterday had a fair bit of open interest. The premium ended closer on 15 rupees. At the high of the day, the premium had moved to around 125 rupees, while at the start it was around 60 rupees. So there was a fair sense of writing being seen at that particular strike. And if you look at the goalpost of this market, you're looking at the 21,500 put on the downside, has more than a crore shares, that has the highest open interest on the put side, while on the call side, you have the 21,800. So for me, that's the goalpost, and I expect the markets to be in this 400-point range. 21,450 to 21,850 will require an additional trigger to break this range on either direction. So let's get to the levels then. 20 DMA on the downside, 21,488. Since I said that 21,500 put was seeing a fair bit of writing, and the premium move from around 15 to around 100 rupees, that's the broad support level, 21,400, 21,450. On the upside, we've seen resistance at around 21,800, so that's going to be the level. The Nifty Bank, crucial. Yesterday, it defended the 47,000 odd mark. You wanted to defend that mark, otherwise we're in for a deeper correction. On the upside, though, the 20 DMA becomes an important resistance zone. Saw a bit of a relief rally yesterday, 120 points. That could be because there was weekly expiry as well that played out. But we'll have to keep an eye out on that mark. On the upside, for starters, the GIFT Nifty, I think, was suggesting some bit of green to kickstart trade. So we'll have a positive start, but we'll have to build on from there. But for me, the stock of the day is going to be Polycab. You have some negative news that came in overnight. Not cheap in terms of valuations. You also have high institutional holding. So we'll have to see how this one reacts, because yes, the stock has corrected from around that 5,500 odd mark, but this is going to be the stock of the day, and we'll be analyzing this one for you all through the day.
Absolutely, because what happened yesterday was that there's an official statement from the PIB, an official government statement from the tax department. They haven't named the company, but they're saying a wire and cables company where they've conducted searches. And that release says that there are unaccounted sales to the extent of 1,000 crores, and goes on to talk about a lot of other alleged irregularities. The company in the past has denied all this, but this is fresh information. It's in writing from the government. So let's see how the market reacts to it. Anyway, let's move on and get you the equity call of the morning. Surendra Goyal of Citi expects 17% year-on-year earnings growth, 12% EBITDA growth across the Citi universe, and an 8% YOY earnings growth, 10% EBITDA growth for the Nifty in the third quarter. Among sectors, he says the year-on-year growth is expected to be strong in autos, industrials, financials, that is non-lenders, gas utilities, cement, and it would be subdued in IT services, banks, and staples. He says key to watch is the bank NIM trends, auto demand, margin trends, and management outlook on capex, as well as rural consumption demand.
Okay, well, let's get you some money market views here. Parul Mittal Sinha of Standard Chartered Bank says that the USD INR inched lower on continued FPI inflows and moderately weaker US dollar. Going forward, she expects positive seasonality in the first quarter, continued inflows ahead of index inclusions to push USD INR lower. However, she adds, forex reserve build-up by the RBI is likely to lead to a gradual INR appreciation. She expects the USD INR to trade in a range of between 82.8 to 83.2 to the dollar in the near term.
On bonds, Parul says India rates moved marginally lower on continued VRRR operations by the RBI and reduction in SDL auction size. She says launch of Bloomberg's consultation for inclusion of India bonds in its emerging local currency index is incrementally positive. She estimates $3 to $4 billion of inflows likely if this inclusion indeed happens. Global rates, she says, in any changes in SDL auction size and budget expectations are likely to drive the market in the near term. She expects the 10-year India benchmark bond yield to trade in a range of 7.10 to 7.25% in the near term.
Well, we've got a lot of stock-specific action to track for you, so we'll just list down the stocks and then we'll get further into detail in the next segment. For the time being, running you through the list. Tata Motors, Ashok Leyland, Electra Green Tech, JVM Auto, Phoenix Mills, Bank of India. We have Kalyani Steel and Steel Strip Wheels. All of them will be reacting to positive news flow. While on the flip side, you'll have Polycab and Axis Gates Tech that will be reacting to negative news.
Okay, well, that's what's coming up here in terms of specific stocks.